there's no fix. There's no way out of this painlessly. And that realization is what will change the psychology of the markets in ways that make them uncontrollable. And then you get this, and this could all happen pretty quickly now because we're already at double-digit inflation. So over the next few years, we could see the next phase of the chaos happen, whatever that phase is, deflation or inflation. And when it does, we'll be pretty close to the end of the system.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend John Rubino, founder of DollarCollapse.com. John, thank you so much for joining us today.
Hey Elijah, good to be back.
I did want to have you back on to discuss what is happening for inflation and what the Fed is doing. It seems like, I know last time we had you on, you were saying that there will be a trend change where people will be concerned about inflation as they are right now, and it'll turn to inflationary fears to deflationary terror, you said. As we see we're in a recession right now, technically speaking, and we're seeing the Fed continue to aggressively rate hike. Your perspective on that, do you see us continuing towards this era of deflation?
Well, prior to the jobs report that just came in this morning, the bond market was signaling a trend change from inflation to maybe deflation, or at least lower inflation, with the 10-year yield dropping dramatically. It went to, the high was something like 3.3%. And then it dropped all the way down to about 2.5%. But on that strong jobs market report we had today, it bounced back up a bit. But the jobs thing isn't nearly as strong as it looks, because a lot of the new jobs are not new people getting jobs. They're people with one or two jobs already taking on a second or third job, which is more of a signal that the economy is weak than it is a signal that the economy is strong. And the other stat that ties into this is consumer debt. And for the past year or so, people have been maxing out their credit cards in order to keep on spending. So consumer spending, retail sales, and a lot of corporate top lines have been artificially strong because people were borrowing money in order to maintain their lifestyles. Well, they're running out of the ability to do that because credit card debt is immense right now. It's one of the highest levels it's ever been, and it's growing dramatically, which means it's going to have to stop growing pretty soon. So people are going to have to stop spending or slow down their spending dramatically in the year ahead, which is just one more indicator that not just the US, but the world's economy is slowing, with all that implies for inflation and corporate profits and maybe stock prices and maybe central bank behavior. So I think that's going to be the trend going forward. This jobs report notwithstanding, we're probably going to be seeing signs of slow or no growth outnumber signs of inflation and booming economy going forward.
And can you expand on the jobs report? Because it was pretty shocking. That's kind of the headline is, shocking jobs report. And it's double the amount of jobs that was expected. So how is this number maybe misleading?
Well, first of all, monthly numbers are just inherently misleading. Usually what happens is the government will pull together a bunch of preliminary statistics and publish them. And then they'll update those numbers. They'll revise them over the next few months. But all anybody remembers is the headline number. And in this case, they do a bunch of statistical adjustments to the raw numbers before they publish them. And in this case, there's a birth and death model, that's what they call it, that the government uses as kind of a little bit of a black box to adjust employment numbers before they report them. And this was an especially big adjustment using that model. And also, as I said, a lot of the jobs that were taken on were second and third jobs, which is a sign of weakness, not a sign of strength for most economies. So probably what will happen with this jobs report is it'll get revised lower later on, or a huge wave of layoffs will hit, and the next batch of numbers will be a lot worse than this. But I don't think we can draw all that much from this number, other than it adds a little bit of pressure on the Fed to continue tightening for a little while longer, because they were getting ready to stop here pretty soon. If we had one more quarter of negative growth and falling interest rates as they had been for a while, and things like that continued, the Fed would have had their excuse to reverse course and start easing again. This puts that off a little while. You got to have top line government numbers that give the Fed cover to switch gears, and this was not good cover for them. So they need a couple of weak employment reports, which I think they'll get pretty soon. So, bottom line, this was probably not a major event, even though the number was pretty dramatic today.
It did seem like that because markets are not reacting dramatically to this number.
Yeah, the stock market was bouncing off a really brutal low that they had hit in June, and I think last I looked, stocks were down a little bit, but not crashing. They're not thinking, oh my, the Fed is going to have to tighten forever. That's too much to draw from this report. The stocks were down on the number, and the reason for that is they think that delays the end of Fed tightening. And it does do that a little bit, but not by much. I mean, if the overall trends are still down, which they are in employment even, most big companies are either not hiring a lot of people or they're laying off people. And, Amazon most recently announced 100,000 employee cut in the year ahead. And a lot of other big companies are doing similar things, but with not quite that big a number. So we'll see that going forward. And employment reports will probably be weaker. And that's why the stock market isn't going crazy today, because they don't think this number is going to change the overall trend, which is down, which is going to give the Fed a chance to shift gears. And that's a much later this year, early 2023 kind of story. And I think by early 2023, we'll be talking about cutting interest rates instead of raising them.
Now, I wanted to get your perspective on how, as we move into a deflationary environment, as you've mentioned, how this is going to impact the stock market. Where do you think we go from here if we are entering into a deflationary environment? Well,
I've learned never to predict where the stock market is going to go over the next 6 months, because it's not possible, at least for me. I'll get that wrong 70% of the time. But I will say that, the stocks tanked earlier in the year, and bonds did too, that's what made the first 6 months of 2022 unique, is both stocks and bonds really got whacked. And that was because inflation was spiking to levels that were seen as destabilizing and were seen as forcing the Fed to tighten really dramatically. So you don't really want to normally you'd want to be in bonds in that kind of an environment. But since inflation was so dramatic in the present, the future didn't even matter to bond traders. They just wanted to be out of anything that was going to get whacked in high inflation. So anyhow, if that trend reverses, and if inflation starts to fall and growth starts to be even weaker than it is now, that's not great for stocks, because that lowers corporate profits, other things being equal. And in general, in the long run, corporate profits are what determine stock prices. But if the financial markets see this as an excuse for the Fed to stop tightening and start easing, then all bets are off. Maybe we go back to risk on with everything. In which case you want to own equities. So I don't know. I think the only thing that we say with certainty going forward is that volatility is going to keep rising until something happens to just crush the economy as it's currently structured. We can't go on like this for much longer. And there will be some kind of a crisis. It might be an inflationary crisis. It might be a deflationary crisis. It might be geopolitical. It doesn't. There's no way to know ahead of time what the crisis will be. But something happens to end this system, and I think that's the big story. Not what stock markets do in this month or in the next 6 months, or whether bonds are a good buy or bad buy right now. It's that the whole system of fiat currency, fractional reserve banking, massive government deficits, unlimited growth, all of these things are going to be proven to be unworkable ideas. And going forward, that's where things get really interesting, because we have to accept that a lot of the things that are out there now are overpriced and are going to crash, and that we have to rebuild something from the rubble, because we're not just going to do the same thing we did previously, which is to inflate our way out of it. We found out what happens when we try to do that too aggressively. We get double-digit inflation, and that can't be allowed to happen. So we'll have to see what we do. But I think the debate, which the gold bugs of the world have been expecting for such a long time, is finally going to come in the not too distant future.
It seems like the system is unsustainable. It could be anything that really pops the bubble. You mentioned a geopolitical conflict. What is your perspective on what is happening right now with China and the U.S.?
Well, financial crises are things that are containable and understandable. You can get through them, you can make money from them. And because of that, they're not terribly scary, at least to me. But this geopolitical stuff is terrifying, because first, we expand NATO to the point where it, from Russia's point of view, forces them to retaliate. And we get what is almost a shooting war between the US and Russia over in Ukraine. In other words, something we didn't have to do. It didn't have to happen. It would have been very easily avoided. And now we're doing the same thing with China, where we didn't need to send Nancy Pelosi over to Taiwan and freak the Chinese out. You can say what you want about the red lines that are being drawn by Russia and China, but the fact is they're nuclear powers, and they're very serious about these red lines. So that leaves the rest of the world with a choice. Do you purposefully cross those red lines to see what will happen? Or do you just accept that, yeah, all right, maybe it's not reasonable, but this really matters to these guys, and they've got nuclear weapons, and maybe we should try to accommodate them and try and respect their opinion out of our own self-interest. It's not that we're caving out of cowardice in Russia, Ukraine, or China, Taiwan. It's that we're putting ourselves on the verge of nuclear Armageddon. And if we don't have to do that, that should be something we try to avoid. And, I'm saying this as a father of 2 sons who really doesn't want his kids to be incinerated this year. That would make this a really bad year for me. And it feels to me like that's the kind of thing, that's the kind of game of chicken that we're playing right now, without any good reason for doing it. It's traditionally, there's this idea that when a country is really badly run and things are starting to get very messy internally, they start looking for foreign enemies with which to distract their people from their own mismanagement. And you could make the case that that's kind of what we're doing right now. We're a mess domestically. We've got an election coming up in which the people in power are probably going to lose a lot of that power. And they're behaving according to that script, where they're picking fights all over the world in an attempt to distract us from the fact that they're screwing things up here domestically. But the fights they're picking are terrifying. It's one thing to get involved in some part of the world where there's there are rebels doing this or a dictator doing that, if they don't have nuclear weapons. But that we're doing it with the 2 major other nuclear powers in the world besides the US is just, I don't know, it's inexplicable, other than complete cluelessness on the part of the guys that are in charge here. Anyhow, any kind of geopolitical trouble on the level of us and Russia or us and China getting into a literal shooting war, which is what we're risking right now, that would be catastrophic for the financial markets. I mean, of course it would give the Fed its excuse to ease, but I don't think the financial markets would find that to be much solace. If we're, if our aircraft carriers are fighting with China's missile batteries or something like that, that's not the kind of thing that is reassuring for anybody who's got money at risk in the world. So we would see risk off on a massive scale. That is to say, gold and silver would go through the roof, bonds would catch a nice bid, stocks would tank, interest rates would spike, housing or at least mortgage rates would spike. Even if 10-year treasury yields go down, it would still be much more expensive to buy a house because people would be terrified of lending money to individuals and that kind of circus. It would be a mess. It would be a huge mess for the traditional financial markets. And let's hope that doesn't happen. We would make money in our gold and silver, but it wouldn't be the kind of world in which that would offset the terror of potential nuclear war. And, it feels to me like that's kind of where we are now. We're right on the verge of stuff like that. And again, as a father, I just find it terrifying. You can laugh about financial crises and stupid Fed statements and things like that, but it's hard to laugh about, military maneuvers with us, China, and Russia all right next to each other, and one mistake starting World War III.
That definitely is a major concern, and one that I'm not sure if we can necessarily prepare for. I mean, a nuclear war, everything is destroyed, and I guess all we can do is pray that that doesn't happen. When it comes to the financial aspects of conflict that might be developing, I mean, one thing that we've seen with the Russia-Ukraine war is the sanctions have really backfired, and countries, including Russia, are starting to move more away from the dollar. So that's kind of accelerated de-dollarization. And it seems like any conflict with China might just do the same there. Your perspective on that, the financial implications, more of the financial implications of a further conflict.
Well, yeah, the big chunks of the rest of the world perceive that the U.S. has been abusing its privilege with world's reserve currency. Instead of making the dollar completely neutral, so that if someone uses dollars, they're not making a political statement, they're not helping one faction in the world at the expense of another, and they're very frustrated by that. So there has been the de-dollarization trend has been kind of slowly building up steam for quite a while, in the sense that other countries are using their currencies to trade bilaterally, in other words, with each other in rubles or yuan or rupee or whatever, and that's turning out to be completely doable. You can buy something from Russia if you're India using your own currency, and it kind of works for all concerned, and it bypasses dollars. So let that trend continue and accelerate, which it kind of is now. They've actually set up a framework now to create a reserve currency to rival the dollar, and it's going to include Russia, China, India, which right there you're almost half the world's population, and maybe Saudi Arabia, maybe Brazil. So we're talking financial heavyweights on the side of a currency that might rival the dollar, and if that turns out to be a real thing, and it turns out to have legs and traction and to actually allow a lot of big countries to bypass the dollar in their trade. And that means there's less demand for dollars in the world, and the 10 or 15 trillion dollars that are floating around out there will come back here. People will take their dollars and they'll want to buy American assets, which will push up the price of American assets and the value of the dollar down. So it's very inflationary if another reserve currency emerges to rival the dollar, because that means there will be less demand for dollars in the world, and the supply of dollars will be excess. There will be too many dollars for the amount of supply amount of demand that's out there, and that'll make the dollar go down in value. So that's another thing that the geopolitical stuff we're doing right now, as you said, it accelerates that process because it makes it clear that they can't trust the U.S. to be a neutral arbiter of conflicts in the world. They see us as on one side, and that side is ours, and it's against them. and they don't see any reason to help us by using dollars and keeping the dollar strong. So, yeah, I think that's going to be a big story going forward. Over the next few years, we'll see how the BRICS currency goes, and they've a lot of those guys have spent a lot of the last few years accumulating gold. So if they wanted to back that currency with gold, they might have enough gold to do it. And then we would have the dollar, fiat currency completely unbacked by anything, being inflated away aggressively, versus a currency that is tied to gold and therefore its supply is limited, which would be a pretty interesting challenge. It's not clear how the dollar would do in that circumstance. I think a lot of people would choose the gold-backed currency. But again, we'll see. None of this is certain, but it's an ominous trend, and it's an ominous trend that we should pay attention to. And, let it go to its logical extreme. Let it succeed. Let the BRICS currency succeed. And it would be potentially catastrophic for the dollar and the euro and the yen. These other currencies are not going to do very well either in the kind of world that might emerge if we keep going in that direction.
What you're saying kind of reminds me of actually a speech by Grant Williams, founder of Real Vision. He was speaking at the Real Symposium, and he mentioned that a lot of the issues that we're seeing nowadays, the root cause of it is a lack of trust. We're seeing a lack of trust in our government institutions. We're seeing a lack of public confidence. You mentioned how there's even a lack of trust between countries right now, and that's a huge issue. But the solution is gold, right? The solution is to have trust restored in our financial system. And you mentioned how if gold is restored in other currencies, then people might dump dollars. But your perspective on that, it seems like we're seeing a lack of trust across the board right now. What is the solution in your mind to that?
Well, even if you take away all the geopolitical chaos right now, and we just have the big countries of the world pursuing their own financial ends as they have been. In other words, by inflating away their currencies at ever increasing rates, the system would still break, and we would have to have a monetary reset of some sort. So the question is, what would we do? And that's unknowable because it's going to be done by people who are under pressure and who don't really understand what it was they did to get into the mess in the first place. So they'll probably mess it up. But if it was done right and not forced upon the big governments of the world by chaotic markets, we would just go back to some kind of a gold standard-ish thing. In other words, link the big currencies of the world to some kind of a commodity, some kind of a base that controls the money creation of those governments. So that, it's only possible to increase the amount of dollars in circulation by 3% a year or something like that, which the governments of the world would hate. But that would restore faith in those currencies because people would know that that there was a limit to how many new dollars, euros, or yen can be created. And getting there from here, almost by definition, has to be really messy because even if governments come to their senses right now and then just announce a new gold-backed currency regime, to do that, they would have to have a massive devaluation of all their currencies because you have to get to a point where the amount of gold in the world actually backs the amount of currency in the world. And to do that, you have to raise the gold price really dramatically versus those currencies. So you'd have this huge bout of inflation, which would be, civil unrest on steroids everywhere in the world and governments being voted out of office. All of that stuff would have to happen. So nobody wants it to happen. But that would be the least painful way for it to happen. The other way is for the financial systems of the world to just collapse. And then the governments of the world be swept out of office and new people coming in and having to rebuild something from the rubble of this system. That's probably the way it goes, just because people don't give up power voluntarily. They have to be forced to give up power. And the guys in charge of the world's central banks and the governments that are financed by the central banks right now have the best power in the world. They can make money out of thin air. So they won't give that up. And the reset that happens will probably happen in a really chaotic way because of that. And it could be pretty soon now. I mean, we've got double-digit inflation in the U.S. already, and higher inflation rates in other countries. So we're close to the breaking point for this system. And the next phase of the process might be that we have that crash in the financial markets. The central banks of the world go back to easing aggressively, and then inflation just comes roaring back. And then we realize that there is no fix. You can't stop inflation at this level from accelerating without crashing the financial system. So there's no fix. There's no way out of this painlessly. And that realization is what will change the psychology of the markets in ways that make them uncontrollable. And then you get this, and this could all happen pretty quickly now because we're already at double-digit inflation. So over the next few years, we could see the next phase of the chaos happen, whatever that phase is, deflation or inflation. And when it does, we'll be pretty close to the end of the system.
No, we definitely on this channel want to be aware and prepared. And we've talked about this before with you, but if you could remind our viewers, how do people be aware in this situation and then also prepared, because we don't want anybody caught off guard if this does really come crashing down?
Well, the solution to chaos is to limit your risk, right? Because you just can't know exactly what's going to happen going forward. And financially, you do that by getting out of risky assets like stocks and long-dated bonds, interestingly, in this kind of a situation. Because those are financial assets that depend for their value on the value of the currency in which they're denominated. So you don't want to own bonds, for instance, in an inflationary environment because they're paying you back in ever less valuable currency. And with stocks, especially financial stocks like the big banks, you don't want to own Wall Street stocks like Goldman Sachs or JP Morgan Chase in this kind of a world. What you do want to own is real stuff that can't be created out of thin air by some central bank with an electronic printing press. So gold and silver, of course, you want silver coins for transacting when everything hits the fan, and you want gold coins for storage of value. And you want those stored in a safe place. And that's kind of the financial bedrock of a crisis portfolio. And then going from there, you can buy stocks, but it's got to be stocks of companies that have real assets. So the gold and silver miners, a lot of the industrial commodity miners, energy companies, the people who bought Exxon over the last year have done amazingly well. And they've gotten a good dividend, even though the stock has been going up. Why? Because energy, it turns out, is something we're going to need going forward in some major form. And we don't have the transition to renewables completely figured out yet. So you want traditional energy, and you also, the things like solar farm stocks will probably do just fine going forward. And the reason is that we're going to need energy going forward. And because of that, there will be steady demand for it. And the guys providing it will probably do okay. Same thing with food. The last thing we'll stop doing is eating. And therefore, assets related to food will do pretty well too. So you want to avoid financial stocks that depend on the dollar. And you want to move your finances into things that really don't care about the currency. They have utility in and of themselves, and they will continue to be valuable no matter what crazy stuff is happening with the Fed and Treasury and bond yield. None of that matters too much if you're making food or energy, which will be consumed by people pretty avidly going forward, no matter what. In real estate, it gets a little trickier because real estate assets tend to be highly leveraged assets. People borrow money to buy them. So, all that money is liable, or all that debt is liable to cause a lot of real estate related turmoil. And the only kind of real estate that you want is farmland, because of the food thing, really well chosen rental houses, because there will be a lot of renters if the home ownership market becomes dicier. And there was one other that I'll think of in a second. Yeah.
Well, John Rubino, we really appreciate your time today. If our viewers are interested in learning more, where can they find you? And did you have any last thoughts for our viewers, and maybe that other form of real estate if it comes back to you?
It hasn't come back yet, but yeah, I founded dollarcollapse.com, which is a website that manages and tracks the kinds of things we're talking about. So I don't run it anymore, but the guys running it are doing a great job, and that's a place where you can find out what's happening on a day-to-day basis in the financial world. And go there, put your email address in the join our mailing list box, and you'll get whatever they publish for free.
All right. Well, John Rubino, once again, thank you so much for your insights today, your time, and God bless.
Thanks, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.